Hey, Bulls, what's going on? It's Chase. It's the Stock Sherpa. It's Chase at Everbullish. Everbullish.com is the website where you can buy portfolios and read my past articles, the free ones. The Substack is where you learn how to trade like a champion. You get my free trades. You get my confirmations. You get my cell phone number, and you have me on retainer to help you trade. But let's get straight to it. This is the Sunday recap. It's May 1st. It's May Day, by the way. I don't know if y'all knew that. Listened to a podcast earlier and learned that May Day is actually a Russian civil workers holiday. Where they celebrate the working party. And then also May Day happened to be the day, believe it or not, that that the Empire State Building was dedicated. Empire State Building, by the way, was created and dedicated in less than 1 year for less than $40 million in the middle of the Depression. And they averaged 4 stories per day towards the end. Kind of interesting shit. So I like to lead off with a fact, try to keep you guys in here. And remember, this is my full-time endeavor. Show me some love. Join the Substack. Definitely subscribe to the channel. And I put these out free on Reddit every now and then just to get a lot of the traders that may be kind of rudderless out there. But anyway, what you get when you get the Substack and what I'm presenting to you today for all my subscribers is the Everbullish Edge, and that is at thesherpa.substack.com. We're going to get right to it. I'm going to be very, very clear. This last week was incredibly depressing. It was a shitty week. All my trades were negative except for the Select Energy trade that I closed out early in the year. And if you followed the Substack, you'd see that we put that up there. I've also been loading up on these TLTs. I also love FAS, even though it dropped. I'm going to be buying more of it, and that's part of the plan today. But I'm going to be very clear here. Very, very, very clear here. There's only one way to trade right now, and it's to be short most equities. So I believe directly right off the bat, if you're listening, if you're watching, don't say I didn't tell you so. And if you follow these trades and make at least $200, which you will on the first trade, use that money to go buy my Substack. It's $20 a month, $200 a year. We're going to be short the SP 500. We're going to be long on the interest rates of the 10-year, meaning short on the price of the 10-year, which is this TLT here. That's an ETF that is, I need to edit that while we're doing it. That is the ETF that follows the price of treasuries. And I'm going to show you a chart here that is inarguable. I do want you to be long oil sector, and I'm going to tell you exactly how to allocate your 401k. If you have a Fidelity 401k like I do, I want you to put that into one fund and cash, and that's it. And then finally, I'm neutral on the banks, and that means a straddle on FAS. Again, if you've been following, all my bulls already know this. Shout out, you're welcome. But with the straddle on FAS, it's that the banks will do well as interest rates go up. And with straddles, I don't believe we've lost money on a single straddle all year. So the game plan is very clear. Just like I said, there's only one real game plan. That's short S&P 500. Amazon and Google just closed out their worst months on Wall Street since 2008. And if you remember 2008, I do, because I just got my Series 7 back then and just started practicing as a broker maybe 3 months before October of 2008, when the market was down 11% in one day. Second worst sell-off in the history of the market, by the way, and the largest sell-off in percentages, not in dollars. I'm sorry, in dollars, not percentages. There's this guy I follow on Twitter, Triple Chin Brandon. We got something in common. We both got double chins. If the S&P is going to earn $215 next year, maybe, and the 10-year is going to be 3.5%, what is cheap? He's talking about the NASI here. 4,100 implies 19 times forward earning in a non-quantitative easing or zero interest rate policy environment. What that means is stocks are way too fucking expensive, even if there was no stimulus, which is what quantitative easing is, and even if there was no zero interest rate policies, which is going away because we're raising rates. So that should tell you why I'm bearish, right? All right, secondarily, let's look at big tech earnings. Y'all know I had a tech trade in. I got crushed on the tech trade. You probably did too. If you did, I'm very sorry about that. And this is how we get out of the hole, by following what I'm saying here. So we got Apple. They beat earnings. They beat expectations. Good deal, right? Microsoft beat earnings, beat analyst expectations. Google did not. Amazon did not. What did I just show you up here? Google and Amazon, right? By the way, over 5% of all the major indices. Probably not good if you're an index investor. So all you boggleheads out there, all you indexers that I always make fun of for being pussies, this is why. Tesla up, great. Facebook beat earnings expectations, did not beat revenue expectations, but barely missed. And I am bullish on Facebook. Netflix, get it out of your portfolio. It's a dying breed. The password crackdown is going to ruin that company. You may catch a bounce if you already own it, but make sure you follow that with trailing stop losses. All right, so the S&P, look at the S&P here, or the SPY at $412. And you just see we had what happened over this period of time. What happened where my cursor is. See if I can zoom in. This is where we had nothing but zero interest rate policies and quantitative easing. And if I zoomed out on this chart to the 5-year or the 10-year, all you'd see is a straight up. But what's happening here? This is the Fed. What's the rule? Don't fight the Fed. When you don't fight the Fed, this is the year to date, by the way, has not been positive really at all this year. So this is why you don't follow the herd. This is why you follow the Sherpa at the top of the trading mountain. So I say buy puts or straddle for a future bounce. I like the idea of buying longer term puts and shorter term straddles. I believe that you'll make money on both. So go out maybe 8 months on a put, 9 months on a put, and own that put, and then buy a straddle. So a call and a put with a month and a half out, you'll make money on both sides. This is why you subscribe to my Substack. Or you can just simply buy an inverse ETF. If you're a broker, I know a lot of brokers follow me. You're not allowed to go bearish, but you are allowed to go long and earn inverse ETF. And I even Googled it for you here. Let me Google that for you. These are the ones I like. SH is probably the most common. That's just one time on the broad market. I like trading with leverage, so I would do UPRO, and that's 3 times if you want the upside. And you can do SDS if you want, SPXU, which is 3 times on the downside. On the treasuries, like we already mentioned, I told you guys to buy puts on the treasury. Those are all printing money, except maybe the last month or so, but they will be printing money because there's only one way for them to go. And also, I get a lot of questions about, is the market pricing this in? The answer is no, the market does price it in, but remember, don't outsmart yourself here. What does the treasury issue at par? What is the par value? What is the treasury issue at? They issue all bonds at par. So no matter what the market price is in, and no matter what that first trade is, it will still obviously mature at par. And there is the future expectation of rates going up, which causes a built-in premium. But once you buy that premium and rates then go forward, it is not built in. So I'm not worried about that. Now, that's why you don't want to own bond funds. That's why I've been telling people not to own bond funds my whole career. That's why I essentially quit my previous company over being forced to sell shitty products that included bond funds no matter what the weather. And that's just foolish. So if you want to know what type of TLT puts, these are the ones from my post about a month and a half ago. And if you're following in Substacks, you'd get these and you would be up in the majority of those. Maybe not this one yet, but it will be soon. And it has been in the past, so you could have already clipped it. Long oil sector. Oil sector is going to benefit from the strengthening dollar. Oils is going to, as a commodity, is going to benefit from the market going down. Oil is also essentially just the talk of the town right now because there is a mega nuclear powerhouse that is assaulting and causing a war that is in the Ukraine. And essentially there's just a lot of things going on where it's who's going to sit at the table with the mean girl. And Germany is doing that so far. Europe is not. We are not. And as those things change, the price of oil will be volatile. So I say go long on it. I say buy ERX, which is the 3 times on it. Y'all know CDEV is my favorite mid cap, small cap. Oxy has replaced ExxonMobil as my favorite mega cap. And then you got Devon and CPE, which are mid cap to large cap ish. And they're also all based in the Permian Basin, which is what I like with oil. You can see the chart there. This is FAS. Do a straddle on FAS, make some money. So we're talking, I just gave you 5 trades. Here's what changed my mind, because I know a lot of people are going to go, hey, you were so bullish and you were buying the bounce and you were trading on tech and you were trading on the banks, and why the change of tune? The change of tune is just an essential fact that I don't really believe in following the news, and y'all know that, but many tech, when I saw this, I really thought about my hypothesis. Many tech stocks that have crashed are still too expensive to buy. That's completely true. If you look at the sector map, it's on my Instagram, everbullish.com, everbullish Instagram. Go to the website, buy a portfolio, subscribe to the Substack. But yeah, go to my Instagram. You'll see the market map every day of what it looks like. And the fact that all the sectors are selling off kind of relentlessly, that oil was selling off when the market was up, that we're pricing in, or we're expecting, that is 50 basis point rate hike. Now the Fed only has 2 options. Option 1 is to not do the rate hike, which they're not going to do, or to pull back off the rate hike and blame it on the market being volatile, which is just going to have an internal kind of negative feedback loop. So by the way, the Sherpa's personal 401k is now 50% FSENX, which is Fidelity Select Energy, and 50% cash. And if you do that and you follow me, you're not going to lose money in your 401k. And also, you're welcome. You're going to be beating the market. If there is a 20 or 30% pullback, you're still going to be positive, and you'll have 50% cash to deploy. I am the Sherpa. I am Chase at Ever Bullish. Get off your ass. Go subscribe to the Substack. You can cancel anytime, or you can prepay it for the year, and you get 2 months for free. You save yourself $40, $200. You're going to make that on a single trade here, and you're also going to get my cell phone where you can call and text. That's the real value. We're just doing it out here. No one else is. So get out of your fucking bullshit index funds. AFG, LFG, LGR. Let's get rich. Sherpa out.